No, I don't think the stock market has put in a fundamental bottom. That will happen hopefully this year, probably later this year. The Fed has really got to cut rates aggressively for that to happen and re-steepen the yield curve. There's no evidence historically of the S&P 500 bottoming as the Fed is still raising rates into an inverted yield curve.
Welcome to What the Finance. I'm What the Finance founder, Anthony Fatsis. So, while a few months ago it felt certain that the US and world economies would experience a recession in 2023, markets and banks have seemed more optimistic, especially recently. Since the start of this year, the S&P is up close to 6%, Nasdaq around 10%, Bitcoin 40%, and everyone's favorite risk on asset Tesla is up close to 50%. So, there's a real question, has the Fed landed the plane, or is this a bear market rally, which will be followed by longer term pain? And I'm sure you'll have a lot to say about this, David. So I'm really excited to talk about this with you. And, you're the founder and president of Rosenberg Research and Associates. So David, it's wonderful to speak with you. Thanks for coming.
Well, thanks for inviting me on.
No problem. So, do you have any inkling that the Fed has successfully landed the plane, or are you in the other camp where you think this is just a bear rally that's going to end badly for a lot of people?
Well, it's funny because the assumption is that the Fed wants to land the plane softly, but it really doesn't. And you remember when they first started hiking interest rates in March of last year, Jay Powell came out and said, we are going to be operating policy without focusing on the supply side. Once burnt, twice shy after being hit by these recurring supply shocks, starting with the COVID, but then, we had the Delta, the Omicron, then we had the war. China, up until recently, with its aggressive COVID stance, every month it seemed like Beijing was shuttering a port city with 20 million people, and of course that clogged up global supply chains. So we had all this supply side cost push inflation, and Powell said, "Forget the supply side. We're going to just operate on the demand side, and the demand side is GDP." So I think that if you're talking about soft landing the economy, I think that the Fed is actually hoping that we'll have a mild recession. I don't think there's going to be a soft landing. I think that would be a classic case of hope triumphing over experience, that you would have had the Fed tightening into the most inverted yield curve since 1981. I don't think that we're going to luck into a soft landing or just a slow growth or a period of stagnation. The economy will be contracting this year, and the Fed's hoping it's going to be mild and just enough to create the slack that's going to take inflation down and keep it down. So that's the hope. But the recession is really, I think, as close to an ironclad call as you can see. Now, look, the market's bouncing back. Nothing moves in a straight line. If you draw, it's funny because if you read and hear Powell, he compares himself all the time to Paul Volcker. Paul Volcker, we had a 3-year bear market. We had back-to-back recessions in 1980, 81, 82. If you look at the chart of the S&P 500 during the Volcker era, in those early years in the bear market, there were multiple bear market rallies in the overall context of a market that was down 30% over about a 3-year period. So look, if you think that you're gifted like Paul Tudor Jones and you could trade these bear market rallies, I say, great, go for it. We had eight bear market rallies last year. We had multiple times where if you didn't test the 50-day moving average, we tested the 200-day moving average. And so you get a lot of these technical, short covering, momentum-based rallies in the market. It's still a bear market. It's a bear market rally. And just as you said before, like, for example, Tesla. The worst performers last year are radically outperforming this year. It's just a short-term repositioning trade into the beaten down stocks. I mean, Bitcoin's a classic example. It's the laws of bear market math. You can go down, 60%, and then you bounce back 15 or 20%, and you get all excited, but you're still basically deep in the hole. And this year, the story has really been one of short covering, and you can see that in the data because the most heavily shorted stocks in the S&P are up 20%, and they've outperformed the rest of the market by a factor of more than 6. When you take out the short covering aspect of this rally, we're up a couple of percent. And so in a period of the year, January typically is positive seasonal. So no, I'm not that excited. No, I don't think the stock market has put in a fundamental bottom. That will happen hopefully this year, probably later this year. The Fed has really got to cut rates aggressively for that to happen and re-steepen the yield curve. There's no evidence historically of the S&P 500 bottoming as the Fed is still raising rates into an inverted yield curve. Historically, the 2s10s curve is 140 basis points. We are 70% of the way into the easing cycle when the stock market bottoms. They're still raising rates into an inverted yield curve. So I would be either making sure if I'm trading this market from the long side to make sure I have either hedges or I know my exit strategy, because I think that the fundamental bear market lows still lie ahead of us.
Yeah, it's really interesting. So, do you think we'll sort of experience the Fed will do what, as you said, what they're going to do? They're going to reduce demand. GDP is going to go down. We might see disinflation, or do you think maybe they're going to try and do that, but we'll still see inflation? Do you have any thoughts on that?
Well, look, we're already seeing disinflation. I mean, the inflation rate, inflation, for an economist, it's like a race between watching grass grow and paint dry. But we've already gone from over 9% to 6.5%. What's interesting is that when you're taking a look at the non-seasonally smoothed CPI data, it's been flat since July. So we're already starting to see disinflation. I think the question for the Fed is, once again, their credibility was under attack for the past 18 months. So this is also for them not just about a fight over inflation, but a fight over their perceived loss of credibility. I don't believe that they lost credibility, but when I say that to most people, they laugh at me. But I think that they took this inflation run up and it surprised everybody. I think even Larry Summers or Mohamed El-Erian were surprised we broke above 9%. I mean, I never thought this was going to happen, but I didn't think there was going to be a war in Europe either. And so I think that the answer is yes. Inflation is going to come down, I think, significantly. I think that we will be close to zero by the end of the year. And I know that raises a lot of eyebrows, but like I said, in the past 6 months, the average CPI sequentially has been zero. And that's before the rental side has played a role. Rent is still a very frustrating development here because of the way it's calculated in the CPI. It is truly a lagging indicator. But when you're taking a look at multifamily construction last year, I'm talking principally about multifamily starts and multifamily units under construction, a record high and up almost 30% last year. When I look at these numbers on the rental side, because remember, it's so important because 30% of the CPI and 40% of the core are rents. That's how I guess distorted might be the right word. It's just so heavily weighted towards shelter. But be that as it may, the way it's constructed with these distributive lags is that, and you're seeing it in real time right now, sequentially, new rents for new tenants have been deflating for 4 months in a row. But it's going to take a while before that kicks in to the way they measured on the CPI. But it's going to be very forceful, I think, in the second half of the year. And I say that strictly from a supply-demand standpoint. I mean, ultimately, if you're going to forecast inflation or prices, you need a supply and demand curve. Well, what's going to happen when I'm taking a look and tracing through multifamily starts last year, units under construction, they're going to morph into completions this year, and we're going to get swamped. There's going to be a deluge of supply of rental units, probably outpacing the demand by a 2-to-1 ratio. So vacancy rates across the U.S. have already been trending higher. They are going to go up significantly, and rents are going to play a big role. So I think actually we're going to have a recession. That's going to play a big role in creating demand destruction. I mean, you're seeing it already. I mean, people were just waxing over 2.9% GDP growth in the fourth quarter. Give me a break. The combination of inventories and declining imports and government transfers gave you all that growth. Real private demand, the cyclical guts of the economy was the grand total of 0.2 at an annual rate. So basically flat. And we can see the momentum going negative on the demand side into the first quarter. I think the Fed just wants to see more of that. And then you get more of that, which I think we will. And we look, the Fed's always slow. The Fed's always slow to raise rates. We just saw that this cycle. They're always slow to cut rates. It's the history of the Fed. They will be slow. But when it comes time to cutting rates, they will be as vigorous as they were when they were raising them. And under a totally different set of economic circumstances than we've had, say, over the course of the past 18 months. You can't take your most recent experience and extrapolate it in the future. And I'm getting a sense that things are really changing at the margin on the economy. Inflation is historically a lagging indicator, but I think the surprise will be not that inflation proves sticky and that it doesn't come down that much. I think it's going to come down more than people think. And so that's what I'm looking at right now, that we're going to get significant disinflation pressures. I think it's already starting, but I think the big deceleration in inflation lies ahead, which is why, my strongest conviction trade for the year is long dated treasuries.
Yeah, it's really interesting. And I know the Fed, they're focusing on employment rate. I think that's one of their main indicators. They're looking at what sort of once unemployment goes up, then they'll sort of start thinking about it. Do you think that's the right way they're looking at it, or should they really just be looking at the disinflation, the
Well,
economic data?
it is what it is. They're focused on lagging indicators. So they're focused. I mean, the unemployment rate is actually one of the constituents of the Conference Board's index of lagging economic indicators, and they talk incessantly about the unemployment rate. Okay. Well, let's take a look at what they're telling us, because the Fed's not telling us we're going to have a recession. Of course, what are they? They're not going to come out and say we're going to kill your job and kill your 401k. That's maybe what they think. It's not what they're going to say. But in December, when they gave us their forecast for 2023, what did they tell us? They told us that their forecast for the unemployment rate, i.e., where they want the unemployment rate, 4.6%. Where are we today? 3.5. So people will say, well, 4.5%, who cares? It's still low. But you see, no. It's not the level of the unemployment rate that matters for the business cycle. It's the change. And you go up 1.1 percentage points, and they're giving it to us on a silver platter. You've never failed to have a recession with the unemployment rate up that much. In fact, historically, when the unemployment rate is up 0.5, 0.6 from the lows, all we got to do is get to 4%, and the recession, as they say in Quebec, les jeux sont faits. The gig is up. In fact, the Fed's telling you we're taking the unemployment rate up 1.1 percentage points. Nobody's paying attention to what they're saying, what they want. They want to create the slack in the labor market and don't fight the Fed. Well, I got news for you. You go up 1.1 percentage points, depending on the assumptions of the labor force participation rate, you've just destroyed 1.5 to 2 million jobs. Now, admittedly, in a labor force of 160 million, not the end of the world, except might be the end of the world for those 1.5 to 2 million poor souls who are going to lose their job in this process. But the reality is that historically, when you're already up 1.1 percentage points, you are already 6 months into recession when that happens. So the Fed's given it to us on a silver platter. I mean, look, Powell told us after Jackson Hole, I'm going to create pain in the household and business sector. Sorry that we created these conditions that now we're like Mary Shelley's Frankenstein. We build up the monster, now we have to tear it down. But that's the business cycle. We've had 11 recessions. It's funny, we've had 11 recessions since 1950. And to most people, it's like it never happens. It's like recessions aren't part of the fabric. They're not part of the business cycle. Recessions are part of the business cycle. Expansions are part of the business cycle. They're joined at the hip. Thankfully, recessions are short affairs. Whether they're severe or not, they're typically short affairs. Not every recession is like the one we had with the great financial crisis. Look, thankfully, 85% of the time we're in expansion. 85% of the time we're in a bull market, okay? But 15% of the time we are in recession. And 15% of the time we are in a bear market. And there's people that say, well, I don't really care. I'm in this for the next 20, 30 years. Sure, go run with that. Most people, though, it's probably beneficial to your family finances to not participate in a bear market, so you don't spend the next 2 to 3 years clawing yourself out of it. But that's where we are. But the Fed is really, as much as they can, giving it to us on a silver platter. Unemployment's going up more than a percentage point. That is all you need to know. They actually are telling you, we believe, no, it's not my view. They believe that we have to create a recession, not a soft landing, that's slower growth. A recession is a national pay cut. It's one thing to basically not get paid a bonus on Wall Street, another thing to get your salary cut. And that's what a recession is. A recession is a cut in your salary. Their hope is that it's going to be mild. Well, we'll wait and see. But the recession, I think, is already starting this quarter.
Yeah, it's fascinating. So I guess, you've already mentioned there that I think you said you're long beta on treasury bonds. If we look at, I guess one thing that we've seen is that the economy doesn't always equal the market. So I guess what impact do you think if we were to go into this recession, would that have a big impact on the market, or is it a bit uncertain?
No. I think that, despite, people say to me, this is the most widely advertised recession of all time. Really? Then why are the earnings estimates by the analysts still like up 4 or 5% for this year? Because even in a plain vanilla mild recession, earnings go down 20%. Earnings are more volatile than GDP is. And there's a lot in GDP that aren't part of the stock market. But in a plain vanilla recession, not even a severe recession, earnings are down 20%. The consensus is that we're going to be up a few percentage points. But so I think that actually the recession, despite all the calls for that it's the most widely advertised. Well, I got news for you. In the past, because people follow the stock market and they think, well, if the stock market's up, I'm on the wrong side of the call on the economy. You saw Paul Krugman. Paul Krugman, and I got a ton of emails. When Paul Krugman says, you know what, I'm not in the recession camp anymore, Paul Krugman is moved to the soft landing camp. And I got a ton of emails about that. Okay. Well, look, if you believe in the soft landing, then you have to believe that it's going to be different this time. This will be the first time ever that we had a 7-month inversion of the yield curve, that the Fed tightened into a 70 basis point inversion. The first time that's happened is 1981. But like I said before, Jay Powell compares himself to Paul Volcker, who created those conditions of two recessions back to back in the early 1980s. And then you have the quintessential indicator, which is the Conference Board's leading economic indicator, which goes back to 1959. And this indicator is down 10 months in a row, and negative 7% in annual rate. That has predicted the recession 100% of the time in the past. I've always preached that there's no such thing in our business of financial forecasting. No such thing as zero. No such thing as 100. No such thing as a sure thing. I've always said that. There's just shades of gray. But all the indicators that I'm looking at are telling me, like, what? We're going to escape a recession, the most aggressive Fed tightening cycle since the early 80s, but we're going to escape a recession. You might as well just come out and say, and I never say it because this is the refrain that paves the road towards business failure, is that it's going to be different this time. It's not going to be different this time in the sense that the business cycle has not been repealed. And that's what really has me concerned, is actually that the momentum this year has been towards a soft landing camp. And no, I don't think so. I don't think that the business cycle has been repealed. I think that yield curve inversions of this magnitude and duration have always led to recession. Conference Board indicator, leading indicator, down 10 months in a row. And I know people will say, well, but the labor market's still strong. Yes. The labor market is always the last man standing. That is a coincident lagging indicator. And the one thing that I would want to point the viewers to is the labor market indicator that is in the Conference Board's leading economic index is not non-farm payrolls. That's in the coincident index. Unemployment rate is in the lagging index. It's hours worked. Nobody talks about this. Hours worked, because companies cut hours first and bodies second. Hours are a leading indicator. You know that hours worked were negative 1.4% in 2022. That's the equivalent of letting go 2 million people, but companies didn't let people go. We created over 4 million jobs in the non-farm payrolls. Of course, we know that number is going to get revised down sharply. But even so, the bellwether leading indicator from the jobs numbers is the work week. And that's giving you a red flag for employment this year. So I don't see that, and I think it's too late. I think whatever the Fed does, they're going to go once or twice, they'll be done, they'll start cutting rates. But remember that the recession ends and the bear market in equities end deep into the Fed easing cycle. And the stock market, bear market, only ends when the Fed has cut rates enough that it takes the yield curve to a positive slope. And my hope is that that'll be a second half of the year story. But remember that the Fed is nowhere close to cutting interest rates, right? That'll be a second half of the year story. The yield curve morphs from inversion to positive slope, and you have me back on your show, and I'll be thumping my fist on the table to go along the stock market into 2024.
Yeah, really interesting. So, from your perspective, I guess as you said, first half of 2023, you think it'd be quite negative. Is that negative for the stocks you mentioned at the start, the high beta, Tesla's, Bitcoin, and is it positive for maybe the, other assets that maybe are low risk?
No, the thing is that look, these stocks had a lot of the multiples were just stupid high. You'll tend to find actually that as interest rates come down, long-term interest rates have already come down, and it's the long duration stocks. It'll be the growth stocks that will benefit from that. But you only very choosy and buy the quality companies that have more defensive characteristics. I'm more concerned about the cyclicals. I'm more concerned. Look, the home builders are a fraction of a percent of the S&P, but they've been flying high on fumes, and maybe partially because mortgage rates have come down. But there is a lot more downside to the cyclical trade. So I don't mind defensive growth. I don't mind utilities, healthcare, consumer staples. I think the things that don't have a big correlation with GDP. Smaller the correlation with GDP, the better. Earnings visibility, and this was going to be a very turbulent period, in my opinion, on the profit side. Last year, one of the positive stories was the Dividend Aristocrats Index, and I think that that'll be a good place to be as well. I think that dividend growth, consistent dividend payout ratios in companies with strong balance sheets and good business models with low cyclicality. It's a narrow margin of where you can invest in the stock market, but if you're going to be having your toes in that risk pool, those are the areas I'd be focused on. I'm worried more about the deep cyclicals, to tell you the truth. Everybody just loves value right now, and I think value, you could argue, especially in the commodity sector and oil, have secular tailwinds, absolutely. But I think that the deep cyclicals, that deep value trade everybody loves, in a recession they're going to have problems, notwithstanding their valuations. And I think that those companies that are growth, that had their multiples beaten up, and justifiably so, but as I said, have good business models and good dividend yields and payout ratios, you'll be able to scale into those before the value stocks. So I'm one of those few people. Like, I'm not talking about growth that are concept or don't have earnings visibility, and it might be fun to trade. I'm not talking about those ones. They might still have downside, and they still have multiple compression to go. But there are quite a few bellwether companies in technology whose multiples did correct sharply that I'd rather own, I think, right now than the deep value stocks that everybody seems to adore. They will tend to get hit hardest if my recession scenario plays out, because, contrary to the view that this is the most widely advertised recession of all time, it's not really in the earnings estimates. That's the problem with that narrative.
Yeah, definitely. So let's maybe go 6, 12 months into the future when hopefully the worst is behind us and we might be going positive. What are the indicators you're going to be watching, or what are the main things you're going to be watching to switch that trade and potentially go long?
Well, look, the stock market. The stock market bottoms 70% of the way into the easing cycle historically, and 70% of the way into the recession. So you really don't want to wait till the very end of the recession. Yeah, because the stock market sees the whites of the eyes of the recession, then it will see the whites of the eyes of the recovery. Remember that the recession ended in June of 2009, but the market bottomed in March of 2009. And there was a lot of money to be made in those 3 months before the recession ended. So you want to have a view as to when we're getting closer to the end of the recession. So that's going to be important for me to identify, how is the business cycle about to shift course. Okay. On top of that, like I said, I got to wait for the yield curve to get out of the inversion. It's going to take the Fed to cut rates. So I said 70% into the easing cycle, 70% into the recession, and that's usually the light at least shifts from red to yellow, if not green. The other thing is just pure mathematics. You don't get fundamental lows in the stock market until the equity risk premium historically will peak at around 425 basis points. Right now we're about 200 basis points. So we got to do the math. What's the math that will get us to an ERP of over 400 basis points, where we get some semblance of relative equilibrium between stock yields and bond yields? And I'm dealing right now in a view that the 10-year goes to 2.5, the S&P goes to 3,400. There was a time period where we almost got there, and now from 4,100 to 3,400, it's going to create quite a bit of pain. But I think that's where we're going. I think that the ERP, and you can create all sorts of combinations, but I think if I had to develop a base case, 2.5% on the 10-year note, 3,400 on the S&P brings us to the typical ERP that coincides with the bear market low in the equity market. So what I'm trying to say here is that if you're going to turn bullish on equities, this is a case of what's going to come first, the chicken or the egg. And this happens in every cycle. Bond yields peak first, and then they come down. The stock market bottoms later. Quite often, the stock market bottoms at least a year after bond yields peak. Well, bond yields peaked in October. But if you're going to turn bullish on stocks, my point is you got to turn bullish. You got to hold your nose and turn bullish on treasuries first, because the stock market bottom is not going to occur with higher treasury yields. The stock market bottom is going to necessarily arithmetically need lower treasury yields, and that's going to require the help from the Fed in taking the cost to carry down at the front end of the curve. Look, I'm just describing the way things have gone. Every cycle's got its own peculiarities, true, but patterns reemerge. It's just the cycle. And it's just this set of centrifugal forces and sine waves at play. These curves that intersect with each other, the market cycle, the economic cycle, the interest rate cycle. And we're just continuing to rewind the movies over and over again, play them back, and you get the same claptrap like I'm getting about soft landing. Oh, don't worry about the yield curve. Oh, the labor market. Oh, I've been doing this 35 years. I've heard it all. But the thing is that there are well-established metrics and patterns. So I do have, in the name of discipline, you can't be stubborn, and you can't be complacent, but you have to be on guard for the signals that have worked in the past. We've got to get the yield curve to be positively sloped. That's important for me. Deep into the 70% into the recession Fed easing cycle, ERP, getting above 400 basis points will be very important bullish signals for me. And I expect that I'll be seeing that I'm thinking by the fourth quarter, we're going to get there. And I'm planning on having a much more bullish view for 2024, but that's putting, the horse before the cart. But, for the time being, I am bearish on equities and I am very bullish on treasuries.
Yeah, great. So, David, thank you so much for your time today. I really appreciate it. So, my last question is, what is one message you'd like people to take away from our conversation?
I think that the one message I would take away is this, which is maintain your resolve, your patience, be disciplined, and be prepared for a year of heightened volatility. And in this period of heightened volatility, make sure that you have liquidity on hand to put to work. Because remember that when we talk about getting to those lows, you want to have liquidity so that you will be the strong hands as the weak hands have to transfer lower asset prices at better bargain levels for you, because you kept the liquidity on hand and resisted the temptation of chasing these bear market rallies that come and go like the wind.
It's a great message to take away. So, David, thanks again. So, if anyone wanted to find more of your work, I know you do a few of these interviews. Is there anywhere else people could find what you do?
Sure, you can just go to the Rosenberg Research website. Just Google Rosenberg Research. You'll find me there, or just email me directly at drosenberg@rosenbergresearch.com, and would love to introduce you to the services and the products that we deliver at Rosenberg Research.
Yeah, perfect. I'll put that on the description below. But, David, thanks again.
Thank you very much. Take care.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.